solvency ratios, guys, solvency ratios, excuse me, focus on company's liability section on the balance sheet, debt situation on the balance sheet. Whether company's cash flow generated is sufficient to meet its short-term and long-term liabilities is the definition of solvency. Solvency ratios. Guys, solvency means that companies being able to pay off its debt against the current assets, of course in value, meaning if there are enough current assets to cover total liabilities. I'm not talking about current liabilities this time. I'm talking about the entire total asset section and entire total liabilities section. This is the distinction between solvency ratios and the liquidity ratios. Lenders are the primary users of these ratios, as we talked about this, creditors, banks, and any lending companies, because those ratios sets the riskiness level of the companies depending on the balance sheet as well. And when it comes to any investments or any additional loan withdrawal or loan application from the hospitality companies, users take a look at, users are the banks, users take a look at their company's solvency ratios, okay? So balancing it out is important for the solvency ratios, and let me just put over here as the solvency, okay? And we have great solvency ratios that we are going to analyze right now, okay? If you can give me 1 second, I'm just going to grab the napkin. Okay, I'm sorry about that. Let me just clear the board right here. Solvency ratios, as I said, are important because we are focusing on the debt side of companies right now, and the solvency ratio is the most utilized ratio when we analyze the company's debt situation, because as I said, being solvent is important for the companies, meaning company is solvent, which means they are able to manage their debt against their total assets. So if the company's total assets are higher, of course in value, are higher than the total liabilities, that means the company is solvent. If the otherwise, company is not solvent. Therefore, this ratio shows the ability of firms, total assets, ability of firms to cover total liabilities using the total assets. Again, not current this time, it's the total assets and total liabilities comparison. We are using the benchmark again. The benchmark is 1 for the solvency ratio, and then we are going to compare our value with the benchmark to determine if we are a solvent company or not. KZLDG, my last name, you can see over here. Little fun. KZLDG Hospitality Corporation has a total of $2,130,000 in assets and this amount of money in liabilities in 2012. The question is so straightforward. We are solving for the solvency ratio, guys, okay? Again, the solutions for the ratios are not too difficult because it is just a simple division or taking the average for the equations, but interpretation becomes very important. I keep repeating this. So solvency ratio is equal to total assets, TA over TL, okay? So total assets over total liabilities. We have both of them in the question. When I do the division right here, 1.27 times, reading that 1.20 times becomes very important, or 1.27 to 1, which is the benchmark, meaning KZLDG has $1.27 of total assets for each dollar value of total liabilities, and there's a cushion of 27 cents to cover other liabilities, or there's a cushion to be used for other investments or anything, okay? Of course, when we do the comparison, clearly 1.7 is greater than 1, which is the benchmark, and it is firm's benefit to have high solvency ratio. You want this ratio as high as possible so you can become a solvent company, okay? If the management has too high solvency ratio, okay, that means there's a little debt financing in there, it may create problems when trying to maximize the company's value or shareholders, owners' wealth. Again, this is the topics of financial management. Again, the balancing it out, very important. You don't want too high solvency ratios. You don't want too low or very low or low solvency ratios. Over 1 is always, always, always preferable by the hospitality companies. Okay. Debt to equity ratio, DE in short, is another solvency ratio, and it deals with debt, total liabilities, and total equity portion of the balance sheet. It shows hospitality establishment's ability to withstand adversity and meet its total debt, both short-term and long-term, obligations using the equity. A high ratio indicates a greater degree of leverage and constantly financial risk. So we don't want this ratio as high as possible. We want solvency ratio as high, but we don't want this ratio as high as possible. Of course, there's a benchmark for 1, and we are trying to see if we have enough, if we are able to cover our total liabilities, which is the total debt, using the equity. So Grande Timea Hotel is the example for this ratio, guys. And then let's just analyze this example and then interpret the results by comparing the benchmark. Grande Timea Hotel obtained a total of $745,000 in liabilities in 2012. During the same year, its total owner's equity value reached to $567,000. What is the debt to total equity ratio? Very easy. Total liabilities over total equity. TL over TE. I have this guy, I know this guy. It is given in the question directly. All we have to do the simple division to come up with the outcome, to solve for this question. 1.31 times, or 1.31 to 1, which is the benchmark. Guys, take a look at this. This portion is very, very important. Please do understand this portion, because interpretations are very important, not for your test, but for your understanding as well, and of course for your intellectual advancement in terms of managerial accounting. This numbers indicates that for each dollar of owner's net worth, this establishment owes creditors 1.31. Is that a good thing? Think about it a little bit. Take a look at the last portion of this. The higher the ratio, the more difficult it is for the businesses to acquire further debt financing, which means additional loan to have, okay? It also brings risk, okay, to the creditors. That means you're a risky company. Therefore, you want this ratio below 1, so you will signal to the creditors or any other competitors that you have enough equity to cover your total liabilities, okay? You can generate enough equity to cover your total liabilities, capital and retained earnings. Therefore, you want this ratio below 1, okay? Not too much low, not too close to 1, but you want to balance it out. It's usually 0.6 to 0.7 is the acceptable range for the hospitality businesses, and most of them in real life, actually most of them are above 1, because hospitality businesses do need to acquire additional debt. Therefore, but in in acceptable range is 0.6 to 0.7. Okay, guys. Very similar. Total debt to total assets ratio. Again, we're gonna have an example. We have the benchmark over here. This ratio measures the percentage of companies' assets that have been financed with total debt, both short-term and long-term. This ratio is highly used by the management to compare the company's total debt to its total assets. How much total assets I have against my total liabilities. Okay. Again, financial risk is on the table, because when we are talking about solvency, we are also talking about financial and business risk, because you want to be a solvent company, but you don't want too much debt. It creates problems when as a company, trying to acquire additional debt. So take a look at this Filton Entertainment Company this time, which is our example for this ratio, and then let's just analyze the situation over here. Filton Entertainment Enterprises has acquired a total of $3,100,000 in assets 2013, and we have this amount of money in liabilities. What is the debt to total assets ratio for Filton? Very easy. Take a look at this. Total liabilities over total assets, right? Very similar to this. Don't get it confused, okay? Because we are interpreting different stuff right now. Guys, as I said, excuse me, as I said, for the ratio analysis, we are trying to touch base with every single corner. We are, we are reversing the scenario, just like solvency and debt to total assets, and then we are trying to find out if we have enough total, if we have liabilities covering total assets, if we have too much liabilities, so on and so forth. So don't get us twisted right here. Don't confuse us, because they are different. They have different meanings. They have different implications and interpretations. So 0.71 to 1, when I do the math over here, because I have the components of this equation, this number shows that dollar of total assets was financed by a debt of 71 cents. So every dollar of your assets is financed by 71% of your total assets. Every dollar worth of total assets financed by the debt, which is 71 cents. The balance of 29 cents was gathered from the owner's equity. So you put 29 cents from your pocket to the investment or anything, and then 71 cents is funded by debt, additional loan. The interpretation is this firm is using too much debt financing because using other people's money. As firms use more debt financing, which drives the higher debt to total assets ratio, it becomes more and more difficult to raise money by debt. So since you're using 71% of a dollar, okay, or the entire investment, if you need additional loan that you need to take out from a lender, it might be difficult this time, because you might not be able to be qualified for the additional loan because you're a financially risky company. Your business is risky, okay? Therefore, potential lenders of money are more difficult to find. Therefore, you want this ratio bottom line as low as possible, guys, okay? Let me just highlight that section as well, but let me just clean the screen first. Okay, you want this ratio, okay, low. How low? It depends. Not too much low, not too close to 1, okay? Maybe 0.5, 0.4, 0.6, depending on the different types of operations based on different types of hospitality establishments. But the acceptability is close to half enough. 40, 60, 45, 55 equity debt is needed as well. Interest coverage ratio is a great solvency ratio. ICR, let's put it that way, ICR, because it shows your efficiency to cover the interest payments out of the loans that you take out for additional investments, for expansion projects, or any other capital projects, okay? Right here. We are going to talk about EBIT this time because we need EBIT. EBIT is the earnings before taxes and interest. Okay, we need that number to come up with the decision. The greater the number of times interest covered, the greater the financial safety and health afforded had by the company, and to signal to the creditors by the management. Okay, in other words, the higher the ratio, the better the company's ability to pay the interest back to the lenders. We all pay interest on car loans, for example. If you cannot pay, it's going to be a bad signal. That means you're risky, you're not generating enough. That's exactly what we are solving for the companies as well, based on the EBIT, earnings before interest and taxes, guys. Okay. Gazillo Hospitality Services right here is the example for this. It owns hotels, restaurants, retail shops, acquired a loan, both $92,000 interest expense, and then, but their EBIT is $246,000. What is the interest coverage ratio? EBIT over interest expense is the equation for this. We have EBIT, we have interest expense given in the question. So when I do the division 2.67 times, what does that mean to you guys? As a decision maker, it's very important. Excuse me, let me just go up. It shows that this firm covers its interest expense by way over 2 times, okay? Meaning, if this firm, whenever this firm takes out additional loan, additional amount of money from using other people's sources, using creditors, it is able to pay more than twice than that company acquired in terms of the interest expenses. Therefore, it is a good signal for the creditors because it is a very high number. Therefore, it reduces the risk in a situation of the company. In other words, this company can double the amount of loan that he can or that the company can purchase because it is able to pay the interest payments up to 2.67 times than what it is paying right now. Okay, so that's a great indicator and solvency ratio, focusing on the interest payments using the debt issuances. Okay, using the debt or including the debt. Another one right here, operating cash flows total liabilities ratios, CF over TL. Remember we had CF over CA, right? So TA, I'm sorry. So this time we have CF over TL. Again, how well total liabilities are covered by the cash flows, this ratio shows it. And then you want this ratio higher or low? What do you think? You want this ratio as high as possible because you want more cash flows to cover total liabilities in your debt situation. Okay, take a look at Mancini Hotel. Mancini Hotel cleared $212,000 in total operating cash flows in 2009. There are 2 years, $444,000 and $612,000 liabilities respectively, 2008 and 9. And what is the CF-TL ratio? Cash flows to operating liabilities ratio. Guys, whenever you have two numbers over here, that means you're about to deal with an average. Average of what? Average of total liabilities. Let me just correct my average TL right here. Average of total liabilities. You know how to take the average. It is right here. And we have the cash flows. We can take the average because we have two different values for the liabilities. And then 40.15%. 40.15% means that the management was able to cover its liabilities with 40.15% its cash flows. Meaning, I can cover my average total liabilities I can only use 40.15% of my cash flows. So I can still use it. That means I am generating enough cash flows, okay? And I can use my cash flows to cover 40.15% of my cash flows to cover their liabilities, okay? But again, the higher values are favorable, higher numbers are favorable, percentages are favorable for CFTL ratio, okay? Guys, this was the solvency ratio. Now we have activity ratio. We don't have many ratios over here. So activity ratios are important. I'm going to talk about it, but before, let me just erase, erase the screen so you can see it better. So I can also write stuff over here, guys. Let me talk about activity ratios more, guys. Activity ratios are focusing on management efficiency using its resources. What kind of resources? Like inventory. Okay. Using resources becomes very important because resources generate revenues, like assets. Inventory is one of the current assets. Resources generate revenues. Therefore, a careful usage, an efficient usage of it becomes very important. That's what we are going to analyze in this part of the lecture, okay? This ratio expresses the number of activity or turnover is occurring during a certain period, okay? Since the inventory and total assets generate earnings and cash flows for the company, it is important to analyze those. So inventory and total assets becomes very important for the inventory, for the activity ratios, I'm so sorry. For the activity ratios, and that's what we're going to focus on in this ratio classes. Activity. Okay. All right. Guys, inventory turnover. Let's talk about the inventory first. Inventory is the large portion of the hospitality operations, rooms, for example, or the conference spaces we have, meeting spaces we have, right? So this is our inventory. But the rooms the rooms are very important because it sets 60 to 70% of it generates 60 to 70% of the revenues, okay? These ratios we're going to talk about right now shows how many times a company's inventory is sold and replaced over a period. Replacing over a period means turned over, okay? All other things being the same, for example, customer traffic, we're going to ignore seasonality and all that. The quicker the inventory, the better it is for the firm, because low turnover implies poor sales, therefore the excess inventory, which is not sold and which is not good at the end, okay? Therefore, we need the quicker inventory turnover, so that means we are selling fast, we are selling more, we are using our inventory, we are replacing the old inventory with the new ones, we are turning it over, and it is very important. Cost of goods sold is heavily used in inventory calculations, okay? Decreasing this cost portion tied to inventory is essential when analyzing this ratio. So decreasing cost of goods sold also shows a careful inventory management, what's in and out, because it will increase your turnover values as well, which is financially beneficial to the companies. Car, hotel, inventory turnover. This just shows like N. Let me just fix it. Car hotel has $220,000 beginning inventory in July. The ending inventory of July is $310,000. Also, this establishment used this amount of worth of goods, rooms, linen, whatever you want to say, as COGS, cost of goods sold, for the month of July. What is the inventory turnover ratio for car in July? Then take a look at our equation. COGS over average inventory levels, okay? Average inventory levels is the equation for this. I'm not gonna go over the average portion of it because you know already, and every single component is given. I can take the average by combining the two inventory values and divide it by 2, and the COGS is also given to me, 7.27 times. The inventory turnover, the inventory is turned over 7.25 times during July. It depends on hospitality establishment by hospitality establishment. So there is no, let's say, 8 times, or there is no, let's say, 12 times, but the higher the ratio, it's firm's benefit. You want this ratio as high as possible, and there is no set range as the industry benchmark, because it depends based on size, hotel size, or hospitality property size, customer traffic, seasonality, and all that. That's why we said all things being equal. Okay, we are holding them constant in the world, in a space, right? In our calculations. Total asset turnover, TAT, okay, is another one because it shows the management efficiency in using the firm's total assets to generate revenues, and therefore the profits that we keep as the retained earnings that so we can utilize for other purposes. This ratio is also indicated that the amount of sales or revenues generated per dollar of assets, okay? Per dollar of assets you have in your system, in your operations, how much revenue you are generating. Due to the nature of the hospitality industry, which we have high dependence on acquiring fixed assets, so on and so forth, firms experience relatively low asset turnover ratios, okay? Because we have to acquire, most of the firms don't have, let's say, $200-300 million in cash to put in the table for the investment deals or to fund the investments. They keep acquiring additional loans, therefore risk situation is getting higher. Remember the solvency ratios. Therefore, low turnover management is not desirable, but it is the reality for hospitality firms in that case, just because of this, guys, all right? But of course, you would like to have this ratio as high as possible, even though it is not always the case in the hospitality industries in real life. All right, take a look at this Hotara Golf Resort example, and let's go over the total asset turnover ratio. Hotara Golf Club acquired $20 million and $25 million worth of assets in 2011 and 2012, respectively. If this establishment generated $37 million total revenue in 2012, what is the asset turnover ratio for this establishment in 2012? We are looking for the TAT, total asset turnover ratio. Again, we have two values. That means we're going to take the average. Don't forget, this is how we take the average. I'm not going to go over this. You know what it is. Total revenue over average total assets. Total revenue over average total assets. Okay. So we can take the average of it. I'm going to show you. So we have the total revenue. This is how I take the average total assets. They are also given to me, all right, over 2. 1.64, what does that mean? Let me just scroll down and let's just discuss this a little bit. This number indicates that each dollar of assets generated $1.64 in revenues. Great. That is just great. I have a dollar worth of assets, okay, piece of the asset worth $1. That piece generates $1.64 in revenues in return. Great, great. Simply, it implies that companies generating more revenues per dollar of assets they have, and therefore it is well, let me just go back, sorry. Therefore it is well desired by the company, okay? By the companies, because you want your assets to produce and produce more revenues, therefore the profits, so that you are able to pay your interest expenses, you are able to pay off your short-term obligations along with the long-term obligations, okay? And then you are becoming a solvent company and a liquid company, which we have more current assets than, or total assets than the current liabilities and the total liabilities, which is your benefit at the end, and your operations will be great. You will have more assets, more revenues than what you owe, liabilities, expenses, and therefore you will be a solvent and liquid company, which is that you lower your financial and business risk, you have more potential for growth, financial growth, and all that. Okay, so these ratios are become very, very important. And this was the third class of ratios we have.